So you wanna go to war with me? You're talking like you think you're royalty. You think that I'm afraid, but I don't break. I heard you question my stability. You think I'll fall just like a guillotine, but I am here to stay. Won't look away. Storm is coming, so you better start running. No, you can't control it. My bones, I'm coming for it, coming for it. I'm coming for the throne. I'm coming for the throne. So you wanna be my enemy? You should've known I'd never kiss the rain. Ice runs in my veins. Won't play it safe. I don't belong with your nobility. Who died and made you king of anything? You think that I'm insane? It's your mistake. Kingdoms rise and fall. I've come to take it all. I'll take it. I've come to take it. Kingdoms rise and fall. I've come to take it all. I'll take it all. Storm is coming, so you better start running. No, you can't control it. My bones, I'm coming for it, coming for it. I'm coming for the throne. I'm coming for the throne. I'm like an addict, do I gotta have it. I ain't even playing, got a really bad habit. If it moves, gotta grab it. Fuse like a magnet, lose won't have it till I'm boomed in a casket. I ain't playing, got a weird mind. If you work 8 hours, I'ma work 9. If the shit tastes sour, you should taste mine. I'ma stay in power for a long time. Get up, nah, I ain't a quitter. Tossing the ball, I'm a really big hitter. Big picture, I'm a straight killer. Passing the song to the highest bidder. Got juice, got gas, I'ma move fast. New shoes, new tracks, like who's that? I'm new, come back, better than last. Yeah, it's a new me, never gonna look back. Never gonna look back. Cause damn, I'm to the last. You move slow and I move fast. And that's facts. Only I can make a change. Slowly take a step today. I'll never be the same. Cause that's what it takes.
All right, y'all, good morning. Happy Monday, July 20th. It is AMC earnings time. Welcome to the show. Let me get the chat down here where I can see it. Not up there. Great results by AMC this morning. We're going to go through that. The earnings call will start in about 18 minutes or so. AMC trading in pre-market at 226. Let me put the results from the upper screen here where we can talk about them real quick. AMC reports second quarter 2026 results, delivering the highest quarterly revenue and adjusted EBITDA in its 106-year history. Total revenues $15.96, $1.59 billion. That is right in line with where I had expected. Net loss was $11 million. Remember, I had told you that the net loss, there would be a net loss due to the one-time non-cash expense due to the extinguishment of debt. So that is why even on that high revenue number, the GAAP numbers are showing a loss. We'll talk about how I predicted versus that negative 11 million in a second. What I really want to focus on today is the operating results. And we can see that by looking at adjusted numbers that will take out that one-time non-cash expense. Adjusted net earnings, $104 million. Adjusted EBITDA, $321 million. Cash and cash equivalents, $778 million. We're going to mentally reduce that by the 2027 bonds that will be paid off here in a couple days. What was that, 125 million or so? But still, all in all, the company's sitting pretty good after this quarter. And free cash flow in Q2. Yeah, second quarter free cash flow, $190 million. That erases the negative $175 million that they had in Q2. So now for the year, even though it's only a little, we are positive free cash flow. Very nice. That's what I was hoping. It's difficult to forecast free cash flow. I wonder if I could bring up my my video and see if I can't remember if I had forecast a free cash flow number or not. Hone, your channel. Videos. Sheet 1.5. I had said free cash flow between 120 and 200, so I got that. I had said revenue at the top here. Let me make this where you guys can see it. Hang on. Top monitor. Why is that top right? Oh, here we go. No. Come on. Here, let's do it this way. Faster and easier. I had said revenue would be between 1.52 and 1.63. It came in at 1.596. So right on spot there. I had said at the bottom free cash flow between 120 and 200. It came in at 190 on spot there. The net income gap, I had estimated negative 50 to negative 85, and it came in at negative 11. So I was off there. I'll talk about that in a second. Adjusted, I had said would come in between 11 and 46, and it came in at 103. All right, so and adjusted EBITDA, I was a little bit low on that too. Why were my GAAP numbers and adjusted numbers off? very quickly while we are waiting on the call to start, let me bring up my spreadsheet and I'll show you guys exactly where AMC excelled. And that is right here in this quarter. We don't need to see those yet. This right here, the OPEX came in at only 458 million. You can see I have some predictive formula here that estimates OPEX based off the total revenue, and my formula was throwing out numbers that were too high. I looked back at historical OPEX numbers. The highest we ever had was right around the number that they had here, 458. So what I have done to have a better outcome on my estimate for next time is I've adjusted this formula to cap out my OPEX at 459. So we won't get these super high numbers. And if I've already back tested it and forward tested it, that's what I've been doing for the last hour. If I had that modification in my formula, I would have been off by only $5 million on this number. The spreadsheet would have thrown off a number of -6 million instead of -11. We talked about this, the one-time non-cash expense. I had estimated 90 million, but I told you guys there'd be some variance in that. It came in at 110. Not a big deal. The bears are going to focus on -11 million. They're going to say you can't even make a profit on the biggest box office quarter of the year. Remember, non-cash expense related to extinguishment of debt is a one-time expense. So what we want to focus on is the adjusted numbers. All right. Dumb Money Ninja says, I hope that Adam Aaron drops the hammer on the shorts and announces the dividend. I mean, I just be honest with you. I know a lot of people, I see a lot of people out there on social media talking about a dividend. AMC is restricted right now from issuing dividends. If you read the new term loan, the old term loan, the new debt documents, the old debt documents, everywhere that exists, AMC is restricted from issuing dividends due to its total leverage ratio and existing debt covenants. A lot of people, I've had people block me in the past 4 days for showing them the company filings. Don't show me the filing, Tony. Just tell me what I want to hear. The company is restricted from issuing dividends. Now, as total leverage ratio improves over the next couple years, dividends aren't impossible as total leverage ratio improves and the debt covenants potentially get lifted. We don't know the exact hurdle of what total leverage ratio allows the company to issue dividends, but when you see that wording go away, or when if AMC says something about it, then we'll know we finally reached that hurdle. But I'm not expecting a dividend in the next couple years. It would be amazing if EBITDA was sustained at a level high enough, or debt was reduced, or both, to a point where we get over that hurdle of a total leverage ratio in a range where AMC could be allowed by the lenders to issue a dividend. But the lenders have this protective covenant in the debt documents and the term loan so that AMC doesn't squander cash giving it to us. The lenders are always going to get paid first. They want to be de-risked. They want the leverage down, debt down, EBITDA up, or both, before money starts flowing to us. Remember, the lenders get paid before us. We get the leftovers. They have a claim on the business. We get the extras. And so that's why those restrictive covenants are in there. And at some point when leverage ratio is improved, then they will say, okay, you're good enough. The balance sheet is de-risked and you can throw some cash to the shareholders. None of this is a bad thing, but there are a lot of people who don't understand finance or don't read the company documents talking about dividends. And I don't know. I mean, maybe it's just hopium. Maybe it's clickbait. Maybe they're trying to get you mad at management. Imagine for the next 2 years if AMC can't issue dividends and all these people are saying, God damn it, Adam Aaron, why won't you issue a effing dividend? It's almost like they're trying to foster ill will against management when management is telling us in the documents that they can't do a dividend. Like, all you have to do is read. Don't be mad at management. The lenders put in a restriction. AMC agreed to it. It's normal. Any company, you know, that has a distressed balance sheet is not going to be able to pay a dividend. These people, in my mind, maybe intentionally, maybe unintentionally, they're making people mad at management. And I don't think that's very cool. So just chill on the dividends. When the day comes that we see a dividend, you'll know we're kind of like approaching the end of the rainbow. I'm thinking, like, let's not even have that discussion till 2028 is where I'm kind of at. And Rolf says a dividend won't materially impact shorts. I mean, guys, let's be honest. The short interest on AMC, if you factor in the current float of 892 million shares, is about 6%. AMC is kind of a dumb short at this point because of how good this year is going to be. And you see that reflected in the reported shorts. There's not that many shorts in this play. And if they pay a dividend, it's not going to materially impact anybody, unless you want to go down the rabbit hole of, but Tony, what about the 1 trillion unreported naked shorts? Okay, wrong channel. You can go have that discussion somewhere else. By the time AMC is improved to the point that they're able to pay a dividend, anybody would be stupid to still be short in this trade. So there's not going to be some magic short squeeze. By the time we get to 2028, balance sheets improve theoretically, right? Let's just say EBITDA's up consistently, free cash flow's good, box office is booming. You're going to see the short interest continue to decline in this trade. And AMC is going to pay a dividend and you'll get the dividend, and it's just going to be situation normal. There's not going to be any squeeze related to a dividend at that point. Milton Bates says a micro dividend plus a large buyback would be a death knell for shorts. Yeah, I haven't even contemplated a buyback for AMC. They gotta fix the balance sheet. A year or two down the road, if we're looking at a materially different balance sheet, maybe we have that conversation. All right, let me mute this. I don't want that music. I got the call sitting up there waiting. It all comes down to fundamentals. Got to have the box office. High box office drives positive free cash flow, drives positive net income, drives improved EBITDA, gives them the ability to, if that is sustained for, let's say, 4 to 8 quarters, gives them the ability to refinance the debt at a lower rate, improve the credit rating, pay off some of the debt. I don't know. Depends on, let's see how much free cash flow gets thrown off over the next year. Right now, AMC has said they're going to continue improving the balance sheet and investing any cash into CapEx, improving the business. Not not dividends. And that is the right thing to do. Keep fixing the balance sheet. Focus on getting the credit rating improved. And maybe in a year, maybe in 18 months, they refinance the debt ahead of the 2029 debt wall for a better rate. This interest rate is killing us. I didn't look and see what was the interest expense. Interest expense, $115 million. I mean, this is almost at an all-time high of interest expense. We all know the debt has been reduced substantially, but due to the interest rate environment and AMC not having a lot of leverage with the lenders, we keep on getting put over the rack on interest rate being charged. Our interest expense is near all-time high, even with the debt having been improved so much. So they got to fix that. Imagine reducing the interest expense and knocking another $30 million per quarter off of the interest expense. That is huge. Are there any triggers to run the stock up? Yeah, I mean, I'm just trading the stock, low boy. I'm not forecasting. I don't cover anything under a 20% short interest. I don't cover it as a short squeeze stock. We're at 6% short interest. What are we waiting for? What I'm looking at is improved revenue, improved cash flow, improved EBITDA, driving a reevaluation of the expected annual earnings. And you kind of see that in the stock price reflected today, up 17%, around 227. Remember when it ran up to $3? If you go read the first page of the prospectus when AMC issued that private placement, $200 million, 95 million shares, they said on that first page, the current share price does not reflect our belief of the value of the stock, and we're taking advantage of that by selling some shares at what did they sell them at? 221. You got to pay attention to what they're saying, not what social media is saying. AMC I want you to go back and read the recent prospectus, first page. Take off your social media hats. Listen to what the company's telling you. You'll have a much better understanding of how to trade this stock, how to optimize your outcomes. As or if box office and free cash flow and all these things stack, then, maybe we get a little bit better price action. But 227 seems pretty good for where we're at right now. And when it ran to 3, AMC said, it's getting over fair value. Let's sell some shares and take advantage of that. Kevin says, if retail owns the float, how will it affect share price in the future? Retail does not own the float. You can go look on Fintel and check the institutional ownership. FOMO, yeah, Jack Max, FOMO could run the price up, absolutely. I would think, if, let's just say Keith Gill were to come back, for example, when we get a FOMO run up, I'd take that. I'll always take a FOMO run up. The call, let me turn the volume back on and see if the music's off.
Determine the company's future results are beyond
All
the
right,
ability
here we
of the
go.
company to control or predict. In light of the uncertainties inherent in any forward-looking statements, listeners are cautioned against relying on these statements. The company undertakes no obligation to revise or update any forward-looking statements, whether as a result of new information or future events. On this webcast, we may reference non-GAAP financial measures, such as adjusted EBITDA and free cash flow, among others. For full reconciliation of our non-GAAP measures to GAAP results, please see our earnings release posted in the investor relations section of our website early this morning. After our prepared remarks, there will be a question and answer session. This afternoon's webcast is being recorded, and a replay will be available in the investor relations section of our, this morning's webcast is being recorded, and a replay will be available in the investor relations section of our website later today. With that, I'll turn the call over to Adam.
Thank you, John. Good morning, everyone, and thank you for joining us to discuss AMC's record-breaking results for the second quarter of 2026. What a quarter, what a quarter, what a quarter. In AMC's entire 106-year history, there has never been a quarter like this one. Needless to say, I'm extremely pleased to report that AMC Entertainment achieved all-time record revenue and all-time record adjusted EBITDA for the period April to June 2026. More than 71 million guests visited our theaters worldwide in the second quarter, 13.5% more than last year, drawn by one of the most powerful and diverse film slates that we've seen in years. Second quarter total revenues for AMC and Odeon increased 14.2% year over year to approximately $1.6 billion, while adjusted EBITDA surged 70% to $321.4 million, exceeding $300 million in a quarter for the very first time ever. Let me say that again so that the prognosticators of doom, who have continued to vastly underestimate the will and the skill of AMC, despite our having risen to meet challenge after challenge after challenge during these difficult past 6 years, can hear me clearly. AMC reported record adjusted EBITDA of $321.4 million in Q2 of 2026. That's up $132 million over the results of last year's second quarter. And you may recall that last year's second quarter itself was a strong one. Both second quarter revenue and second quarter adjusted EBITDA exceeded Wall Street's expectations and established new all-time high points for our company. Equally important, we converted this outstanding performance into generating cash. Free cash flow for the quarter was $190.1 million. You all have known for some time that the overall industry-wide domestic box office was showing strength in the quarter. At $2.99 billion, it was the highest second quarter in 7 years. And perhaps of even greater note, of the 200 quarters in the past 50 years for which I have been able to personally scrutinize the statistics, this was the 5th best quarter ever in the past half century. Indeed, in the second quarter, 6 different film titles coming from Universal, Lionsgate, A24, and 3 from Disney had impressive domestic opening weekend grosses exceeding $75 million or more, in some cases, far more. But AMC did not just benefit from the rising box office tide, which, as you know, saw an overall 10.7% bump domestically. We also increased AMC's market share as our domestic ticket revenues were up by even more, up by some 11.4%. Our European numbers also shined, as evidenced by our European attendance in the second quarter, increasing by 18% year over year. And I might add, with our European second quarter adjusted EBITDA more than quadrupling over the second quarter of a year ago. Globally in the quarter, we also successfully grew our food, beverage, and merchandise sales, which increased by 15.3%, as did our so-called, quote, other revenues, unquote, which increased by 16.1%. By now on this earnings webcast, you're probably hearing a common theme of one word being repeated over and over again. Increasing, increasing, increasing. And doing so with increases of double-digit growth. But happily, we get to use a different but equally impressive qualifier when you all take a look at just how well AMC kept a tight lid on our costs. With so much zeal in cost management, our adjusted EBITDA margin jumped from 13.6% in last year's 2Q to 20.1% in the quarter just completed. This all demonstrates the inherent operating leverage in our business model, which is significant at a time of rising revenues. The power of AMC's market-leading position stems from our size and scale, of course, but also from the compelling appeal of our theaters, the increasing numbers of our premium offerings, the prowess of our marketing programs, as well as our ability to keep our costs in check. Finally, after some admittedly tough years, as our industry recovered only slowly from the ravages of COVID-19 and its aftermath, the relentless focus of AMC on delighting our guests has seen AMC executing with all cylinders blazing so far throughout 2026. Combining both the first and second quarters of this year, AMC's revenues are up 16.9% year over year, and our adjusted EBITDA for the first 6 months of $359.7 million in the first half of 26 is considerably more than 2.5 times the $131.8 million reported in the first half of last year. Think about this as you reflect on the operating leverage inherent in AMC when revenues are rising. For the first 6 months of 2026, AMC's adjusted EBITDA is some $228 million above that achieved in the same period last year, up $228 million. As you've been learning this morning, the AMC story of 2026 includes our vastly improved operating results. But we also should speak to the enormity of the progress that we've made in strengthening the AMC balance sheet. Sean will walk you through the details in a couple of minutes. Suffice it to say, we have $1.7 billion less debt than we had at the end of 2020. Assuming static overall market benchmark rates, interest expenses decrease as our debt levels decrease, and with rising adjusted EBITDA, interest rates also decrease as our leverage ratios improve. Thanks in part to our success in generating free cash flow, and thanks in part to our success in raising equity. Take it all together, AMC had $778 million of cash on hand, excluding restricted cash, at the end of Q2 2026. And importantly, we do not expect any significant debt maturities prior to the year 2029, 3 years from now. Looking ahead, we continue to be ever so optimistic. This weekend's powerful debut of Universal Pictures and Christopher Nolan's The Odyssey, with an encouraging media-reported $124 million domestic opening weekend gross, is the latest reminder of the strength of today's theatrical marketplace. Indeed, we also announced this morning, in addition to second quarter earnings, that there were some 4.3 million guests in AMC theaters and Odeon cinemas this weekend from Thursday to Sunday. 4.3 million people in our theaters, big, big numbers. That outstanding debut of The Odyssey will be followed a mere 2 weeks from now by Sony's highly anticipated Spider-Man Brand New Day, for which advanced bookings suggest yet another box office triumph is at hand. There will be more exciting movie weekends this year, especially including when Warner Brothers will be releasing Dune Part 3 and Disney will be unveiling Avengers Doomsday just before Christmas. Accordingly, we believe that movie theaters will enjoy in the full 12 months of 2026 their strongest yet post-pandemic year at both the domestic box office and at the global box office. The summary of 2026 so far is that our strategy, our execution, and our preparation at AMC all came together as the recovering box office met a strong, lean, and well-positioned market leader in the largest movie theater chain on earth, AMC. In short, $321.4 million of adjusted EBITDA, the best in 106 years. What a quarter, what a quarter, what a quarter. With that, I'll turn the call over to Sean Goodman, our CFO, who will walk you through our second quarter financial results in greater detail. After that, I'll return to highlight some of the consequential strategies and actions that encourage us greatly as we move forward. Sean?
Thank you, Adam, and good morning to everyone. We are indeed proud of the Q2 results. They delivered the highest quarterly revenue and adjusted EBITDA in AMC's entire history. We did not simply benefit from a stronger industry box office, we outperformed. In the United States, admissions revenue increased by 11.4%, approximately 70 basis points ahead of the industry box office growth that was 10.7%. And in Europe, our attendance increased by 17.9%, and that's approximately 170 basis points ahead of the relevant industry attendance growth. The success of our initiatives around the market share, per patron profit, cost management, and portfolio optimization, coupled with the benefits of operating leverage, drove the second quarter adjusted EBITDA up 70% to the record $321 million. That is more than $30 million ahead of the previous record that was achieved almost 9 years ago when our attendance was approximately 23% higher. Comparing Q2 2026 results to the prior year, approximately $200 million of incremental revenue generated $131.9 million of additional adjusted EBITDA. That's a roughly 66% flow through that drove our adjusted EBITDA margin up 650 basis points to 20.1%. The second quarter's performance was broad-based across our global circuit, with food and beverage revenue per patron and total revenue per patron hitting new all-time highs in both the domestic and their international businesses. In the United States, adjusted EBITDA increased by 57.5% year over year to $285.6 million, while in Europe, adjusted EBITDA increased by 337% to $35.8 million. Note that when comparing our second quarter to 2026 results to the prior year, international revenue and EBITDA benefited by approximately 2% from European currency appreciation versus the US dollar. And also note that 2026 general and administrative expenses benefited from an approximately $5.5 million credit associated with insurance recoveries. It's informative to compare our results this quarter to the second quarter of 2019. That was before the onset of the pandemic and before the strategic actions that we have taken over the last 6.5 years. In this year's second quarter, the North American box office was approximately 7.5% less than the second quarter of 2019. Yet in Q2 2026, AMC generated 6% more revenue and 39.5% more adjusted EBITDA than we did in Q2 2019, with attendance at our theaters approximately 26 million people, or 26.5% less than in 2019. So we generated more revenue and significantly more adjusted EBITDA in a lower box office environment after 7 years of inflationary cost pressures and with approximately 16% fewer theater locations. This very clearly illustrates that we do not need the box office to return to pre-pandemic levels to achieve the same levels of EBITDA. This is because of the actions that we have taken and that we continue to take to enhance our market share, grow profit per patron, reduce our cost base, optimize our theater portfolio, and invest in the guest experience. During the second quarter, we closed 7 theaters and introduced 6 new premium large format and 25 new XL or extra large auditoriums. Since 2020, we have now closed 225 locations. We've opened 66 for a net reduction of 159 theaters, or approximately 16% of our global circuit. We have at the same time also added 77 premium large format and 193 XL or extra large auditoriums. This increases the number of premium or enhanced auditorium options available to our guests by more than 50%. Now let's move to the balance sheet. Our priorities are clear. 1, maintain sufficient liquidity. 2, reduce borrowing costs and extend maturities. 3, lower financial leverage. And 4, invest in high return opportunities that enhance the movie-going experience at AMC. During the quarter, we successfully refinanced $400 million of debt that was due in 2027, thereby extending the maturity by 4 years. We also eliminated approximately $155.8 million of exchangeable debt that was due in 2030 through its conversion into equity. And we completed $150 million of at-the-market equity offering, raising more than $85 million of gross proceeds during the second quarter. In addition, we recently completed a $200 million registered direct equity offering with several institutional investors. Following the closing of that transaction, we exercised our right to redeem the remaining $125.5 million of 6.8% senior subordinated notes due in 2027. This redemption is subject to a 30-day notice period, and as such, the subordinated notes will be redeemed on July 24, 2026. As a result of the debt refinancing and repayment actions taken in the second quarter, we do not anticipate any material debt principal payments required prior to 2029, and our go-forward annual cash interest expense will be reduced by approximately $16 million. Our outstanding first half of 2026 financial performance, together with a meaningful improvement in the balance sheet, has resulted in a substantial reduction in our financial leverage ratios. And thanks to the terms that we negotiated in our various debt documents, the financial leverage reduction achieved during the second quarter is expected to trigger a reduction in interest rate paid on approximately 75% of our debt. This will result in a lowering of the annual interest expenses by approximately $51 million. Yet another significant step in the transformation that we've been driving over the last 6 years. At the end of June, thanks to free cash flow generation of $190.1 million and the benefit of the capital raised during the quarter, our cash on hand was $778 million, excluding $42 million of restricted cash. It is important to note that on July 24th of this year, $125.5 million of cash will go out to be used for the redemption of our subordinated debt. As you may recall, our working capital cycle is closely tied to the seasonality of the box office. Generally, this has resulted in a positive cash impact from working capital in the second and fourth quarters, and a negative cash impact in the first and third quarters. And we do expect this cadence to continue through 2026. With a strengthening balance sheet, enhanced cash position, and a resurgent box office, we're continuing to execute on the highly successful AMC Go plan. And we expect net CapEx for 2026 to be between $200 and $235 million. As we look ahead, we are optimistic about the ongoing recovery of global box office and confident in our ability to convert box office growth into significant growth in profit, cash flow, and ultimately shareholder value. And with that, I will turn the call back over to Adam.
Thank you, Sean. I want to briefly address a few key topics, 6 to be specific, before turning to your questions. First, one of the reasons AMC continues to outperform is the strength of the relationships that we have built with our guests through our industry-leading loyalty programs. More than 40 million U.S. households, for example, have participated in our AMC Stubs loyalty program, creating a direct and ongoing relationship between AMC and our guests. It is especially helpful that we know exactly which movie genres and which movie titles they have seen in our theaters. Through our loyalty programs, we're then able to develop a valuable understanding of our guests, reward their patronage, and encourage them to visit our theaters for the movies that they most like more often. AMC Stubs members represented just more than 50% of our total U.S. guest count in the second quarter. Second, benefiting from our many best practices learnings from our highly successful limitless subscription programs in Europe, I cannot rave enough about the success of our A-List subscription program in the United States, the one that lets you see up to 4 movies a week for a flat monthly fee of somewhere between $24 and $30 a month plus tax. At the end of the second quarter, more than 1.1 million moviegoers were members of our A-List program, more than double the membership that AMC's A-List had just 5 years ago. A-List is such a popular program, especially among Gen Z moviegoers, and it gives AMC a more consistent and increasingly more predictable cadence to welcome a younger generation to flock to movie theaters, as their parents and grandparents did before them for decade after decade dating back a full century or more. Indeed, A-listers who also get to participate in our AMC Stubs loyalty program were responsible for right around 20% of all AMC theater patronage in the U.S. during the second quarter. Think about that. 1.1 million people out of the 330 million Americans are so loyal to AMC that they represented about 20% of our movie-going customers in the second quarter, which itself was so successful. Third, Sean often mentions with great satisfaction our closing non-performing theaters and opening shiny new ones. What is so impressive here is that the theaters that we're opening so outgross and have so much more combined profitability than the theaters that we've shut. What's more, our willingness to do so also has given us the credibility we need in the theater landlord community to successfully renegotiate and receive much more attractive lease terms on many of the theaters that routinely come up for renewal each and every year. Fourth, AMC is the movie theater chain that led the way with recliner seating, both in the U.S. and at our Lux branded theaters across Europe. Ironically, many of our highest grossing theaters simply can't take reclining seats because they require so much seat loss. We just can't afford to give up those seats in theaters that are so thoroughly patronized. Fortunately, we have a solution to this conundrum. Our relatively new branded AMC Club Rocker seat is much more attractive and much more comfortable than the seats that preceded it. The seat loss is but a fraction of the seating given up to install full recliners. And it also costs only a fraction to deploy the Club Rockers compared to what we previously were investing. The AMC Club Rocker seats propelled AMC Burbank, AMC Lincoln Square, and AMC Empire to be among the highest grossing theaters across the entire country week after week after week. Just as it has been for the past several years, we will remain highly disciplined with our capital expenditures efforts. But even so, we have figured out a way to relatively inexpensively get more of these Club Rockers into more of our top performing theaters, which will make them even that much more appealing to moviegoers. Fifth, I've noticed that many analysts have been writing recently about the power of extra large format and premium large format screens. I want to remind you how much of a commanding lead AMC enjoys, most importantly with IMAX and with Dolby Cinema, among others, along with our house brands, consumer preferred premium products all, and proudly featured in the world of AMC in the US and Odeon in Europe. Globally, AMC and Odeon now have deployed and operating some 226 IMAX screens, 182 Dolby screens, 83 iSense screens, 47 Prime screens, 14 ScreenX and 40X screens, along with 193 XL screens. Just about 750 in total. No other movie theater chain on earth comes even close. And these auditoriums are so popular. They represent only about 8% of our total screen count. But for the Odyssey this weekend, for example, they generated more than 50% of our total ticket gross for the film. IMAX especially performed fabulously well with The Odyssey. Chris Nolan's epic movie was filmed entirely with IMAX cameras, and our IMAX auditoriums are just packed right now. That's a real triumph for both IMAX and for AMC. It's no surprise then why AMC and Odeon are so committed to further increasing the number of our PLF and XLF screens. Mostly using third-party capital to get there, I think that we can affordably increase that total count of our PLFs and XLFs by 100 and 250 more auditoriums over the next 2 to 4 years. And finally, sixth, I really want to salute our headquarters staff and our theater teams in the field for the creative ways in which they have controlled costs so far in 2026. It would almost be not mind-numbing on this webcast today to try to walk you through all the line items on which we've been vigilant in keeping costs in check. But you should know.
But please
There
do.
are success in the second quarter.
We can see the results.
Driving more EBITDA than almost any of you expected came from our determined efforts, first to get revenues growing, but to get them growing at a far faster pace than that of expense growth. With that, Sean and I would be pleased to take your questions from analysts and our retail shareholders following a quarter in which I forgot to mention it before, generated some $321.4 million, a 106-year record for AMC.
Thank you. If you'd like to ask a question, press star 1 on your keypad. To leave the queue at any time, press star 2. Once again, that is star 1 to ask a question, and we'll pause for a moment to allow everyone a chance to join the queue. And our first question today comes from Mike Hickey with StoneX. Your line is open. Please go ahead.
Hey, Adam, Sean, John, congrats, guys, on an incredible 2Q, strong first half performance. 2 questions, Adam. The first is probably your point 6 on your team's cost discipline here, which has been exceptional, holding your OPEX basically flat in 2Q. How sustainable do you think that cost discipline is in the second half? And would you expect continued revenue growth to drive similar operating leverage?
Thanks, Mike. And by the way, Mike, our top lawyer at Weill Gottschall is named Michael Hickey. So it's very confusing. That's very confusing. All right. Thanks for your nice words about the quarter. It was quite a good one. There were a few one-time items in the second quarter last year and this year. So I don't know if we'll have exactly the same expense growth going forward, expense growth containment going forward as we had at Q2, but that's a small piece of what was going on in Q2. What was really going on in Q2 is just we really contained costs. And I'm so proud of our people because it took, 30,000 of them across 850 theaters, as well as in our headquarters organizations in Europe and the U.S. to pull it off. We're going to be maniacal in continuing to try to keep our costs down. Will we have the full 700 basis point improvement in adjusted EBITDA margin every quarter going forward that we had in Q2? I guess that remains to be seen based on how strong the revenues are and how much we can keep a lid on costs. But we're going to do everything in our power to maximize and drive revenue growth and keep costs under control.
Thanks, Adam. The free cash flow also exceptional, $190 million free cash flow in 2Q. I guess at this point, and I know that you've brought your leverage down, you reduced your interest expense. That all seems very positive for the second half and overall annually. Do you have a sense at this point the level of box office that would be required for you to consistently generate positive free cash flow moving forward?
To how many decimal points would you like that answer? We know exactly what the break-even box office needs to be for us to be free cash flow positive on a 12-month basis. Right now, it's right around $10.4 billion, which is so impressive because if you compare what it was back in 2019, pre-pandemic, add 7 years of inflationary costs and wage pressure, among other things, and everything is more expensive that we buy, because as everything that everyone buys is more expensive over 7 years. You would have thought the break-even box office would have been much higher, but we've done such a great job in increasing our profit per patron and controlling our costs. We're within sight of being cash flow positive, not for a quarter, but for a year. And the efforts to continue to drive that break-even box office level downwards continue. If in fact we are successful in continuing to get lower interest rates going forward, and Sean deserves to be justifiably proud of having built some automatic triggers into our various debt instruments, that as our leverage ratios improve, our interest rates fall, and that's exactly what's happening right now with the strong operating results from the second quarter and having paid off or converted into equity a bunch of our debt so far this year. If interest expense goes down, that means that the break-even box office level goes down as well. As I said to your earlier question, Mike, we're going to continue to do all in our power to drive revenues. Remember that something like 2/3 of our incremental revenue dollar falls to the EBITDA line. And we're going to do everything in our power to keep costs under control. We're not quite at break-even neutral for the full year, but boy, are we close, and there's so much improvement over we've been since 2019.
Thanks, Adam. Thanks, guys. Congratulations.
Thank you. And our next question will come from Alicia Reese with Wedbush. Your line is now open.
Thanks. Great numbers, guys. Congrats on the quarter. I have a couple questions about international. Just looking at the admissions revenue per screen growth of 20% year over year, and that's on a 34% growth last year in the second quarter. It's a really nice growth in the first quarter, strong expectations for the back half of the year with a good slate. I wonder if you could talk about, you had mentioned about 250 more premium large format screens expected for the full, I think, global print over the next 2 to 4 years. To what extent have you completed your upgrades in Europe, and are those driving results? And to what extent are you still taking that 250 and driving that higher?
Alicia, I'm going to let Sean answer your question because our international theaters actually report to Sean in addition to his CFO duties. But I just want to clarify one thing. What I said on my prepared remarks is that we'll do somewhere between 150 and 250 more premium format and extra large format screens, the so-called XL and AMC screens in the US and XL screens in Europe. We have 193 of them now. I'm sure that we can add 100 more, maybe more than that, across the US and Europe going forward. So there's a lot of opportunity to add more screens. And we do get a healthy price premium for our premium products. Here in the US, for example, our IMAX auditoriums, our Dolby Cinema auditoriums, usually are carrying something like a $6 or $7 price premium over a traditional auditorium. Our Prime auditoriums and our iSense auditoriums are also commanding healthy premiums, and even our XL screens are commanding smaller price premiums, but price premiums nonetheless, basically up maybe 10% above normal auditorium pricing. And not only do we get higher prices for these premium products, but they're also the auditoriums that book first. And you just need to look at this one weekend on Odyssey that our premium and extra large format screens were 8% of our screens, but 50% of our growth. I mean, you know, the premium format screens and extra large format screens have the generating power of, 6 times that of a normal auditorium. So you can be sure that we're going to do all in our power to increase the number of IMAX auditoriums in our system, Dolby Cinema auditoriums in our system, ScreenX and 40X auditoriums in our system, and our house brand Prime and iSense auditoriums and our XL screens. With that, do you want to make a further comment, Sean, about Europe?
Thanks, Adam, and thanks, Alicia, for the question. We are very fortunate because, in line with what Adam is saying, we have a very long list of extremely high return projects, longer list than we could afford to actually invest one particular point in time. We're also fortunate that we're able to get co-funding from our technology partners, from our landlords, to do investments in our theaters. The opportunity in Europe is pretty much the same as it is in the US. The recliner penetration in Europe is actually quite significant than in the US, so there's an increased opportunity with recliner penetration. The Lux theater conversions that we've done in Europe have generated extremely high returns. And so those opportunities exist, and we're spending at the moment pretty much a proportionate amount of capital in the US and Europe, and on these very, very high return projects.
And I might add, for as excited as we are about the current profitability in the second quarter of AMC, there's so much operating leverage in our company that when revenues rise, EBITDA rises at a much more rapid clip. And as Sean said, there are a lot of growth opportunities that we look at, but I don't want anyone to have the wrong takeaway from this conversation. If you look at the last 6 years, AMC has been incredibly disciplined in our capital expenditure efforts. We've skinny down CapEx and embraced only the most obvious successful products and projects. We intend to continue to be extraordinarily disciplined in our capital expenditure process as we go forward.
And as a quick follow-up, can you just discuss briefly the ROI on the European recliner upgrades and just compare that to US back when you were doing that, and the premium and large format screens as well? Is the ROI similar to US?
Yes is the simple answer, and they vary project by project, but it's not uncommon for us to see ROIs achieved of 30% or more, 40% or more, 50% or more. On the Excel screens, they were so inexpensive to create because the screens already existed. We just didn't necessarily market that we had them. The IRR of the Excel screens is pretty much infinite. Our total cost to put an Excel screen in place, Excel screen, for which we're getting a 10% price premium in perpetuity, at least if current pricing were to continue. I don't want to make any forward-looking statements about pricing. But our expenditures for an Excel screen were under $20,000 a screen. I mean, the returns are really high when you can create a product of close to 200 screens globally and spend very little money doing it.
And I'll add to that as well, as one would expect, the returns are also really high when you can get co-funding from your landlords or your technology providers as well. And given what I said at the beginning about a long list of very high return projects, because of that and because of our disciplined approach to capital spending, we're investing in the highest return of those projects. So we're really investing in very high return projects that are going to be beneficial to our revenue and profit growth going forward.
Excellent. Thank you, gentlemen. Appreciate your responses, and congrats again.
Thank you, Lisa.
Thank you. And our next question comes from Chad Beynon with Macquarie. Your line is now open.
Hey, good morning, Adam and Sean. Nice quarter. Thanks for taking my question. Wanted to ask just about the per patron spending metrics. Obviously, this industry has always been affordable compared to other out-of-home options, particularly what we're seeing with World Cup pricing, concerts this summer and a number of other subsectors. But how are you thinking about pricing opportunities? I know you've already talked a lot about premium format and kind of what that does to pricing. But are there still opportunities either on admissions or concessions in the back half of the year or 27 to keep raising pricing? Thank you.
So, Chad, I was schooled as a young marketer that it's patently illegal for me to talk about pricing strategies on a going forward basis. So I'm not trying to duck your question, but I can't answer your question. But I can answer your questions a different way. What I'm very proud of, looking backwards, not looking forwards, is AMC has done a really successful job of raising price where we should when demand is strong and reducing price where we should so that bargain hunters can find appealing ways to get into our buildings and buy stuff from us profitably. And just some examples. Last July, for the last more than a decade, the movie theater industry has had cheap pricing on Tuesday. Last July, AMC took that cheap pricing on Tuesdays and instead added another second discount day by introducing cheap prices on Wednesdays. 50% off Wednesdays, 50% off Tuesdays. It was brilliant, if I do say so myself, because prior to that effort, we didn't have anybody in our movie theaters on Wednesdays to speak of. And now Wednesdays is a strong day for us. So there's an example where reducing price worked. Another example of reducing price, A-list. Now 20% of our patronage. Our A-list members have the right to go to four movies a week. That's 17 movies a month. They don't go to 17 movies a month. They go to two and three movies a month. But they have the right to. They can do. Some do. Like many occasionally do a lot more than 2 or 3 in a particular month. But this has given us a great opportunity to drive movie-going to secondary movies that might not have made the blockbuster cut, and also allow us to sell more food. So there are examples where we have reduced price. But, as you say, we have certainly not been shy at AMC in raising price for our premium offerings on weekends, for our blockbuster titles. I could give you example after example after example where we have proven to ourselves and to the outside world that there, again, looking backwards, not looking forwards, that there has been price opportunity and that AMC has smartly been able to take it. And if you compare the average ticket price that AMC achieves, and you compare that to all the other large mass operators, you're going to continue to find and believe that AMC is more successful in commanding higher ticket pricing than our competition. That is a testimony to our proven ability to smartly price, both in having raised prices where we should and having reduced prices where we should.
And if I could add just one thing, is that we shouldn't completely equate revenue per patron increases to price increases, right? Because in the case, for example, our average ticket price, significant portion of that increase is driven by the mix. More guests choosing to go to premium formats and willing to pay for that price. In the case of food and beverage per patron, is driven by us introducing of the movie-themed popcorn containers, which have been incredibly successful. Now, if you look even at the case of our other revenue, it's driven by adding new revenue streams such as retail popcorn, etc. So we can grow our revenue per patron without necessarily increasing price. It's providing new opportunities for audiences to go to premium formats, providing new movie-themed content, movie-themed merchandise, etc., to excite the movie-going experience, etc. That drives the revenue per patron up as well.
And we are cognizant that the market's opening in 7 minutes, so we're going to make sure we try to be quick. But I'm just so proud of this. I keep bursting at the seams. 4 years ago, our movie-themed merchandise business had revenues of 0 because we weren't in the business. This year, 2026, full year, when you add up our U.S. movie-themed merchandise and our European movie-themed merchandise, we should exceed $100 million in movie-themed merchandise in our various theaters. Like, that's out of thin air. Good for us.
Thank you both. I'll leave it there. Appreciate it.
Thank you.
Thank you. And our next question comes from Patrick Scholl with Barrington Research. Your line is now open.
Hi. Good morning. Thanks for taking the question, and congrats on the record results. Just following up on Mike's question on maybe like the level of box office. Is there like a level of box office or leverage level, and you've made great progress on that over the past few years, but like a leverage level where you'd be more comfortable with the balance sheet?
It's not the leverage level that we've had over the past 6 years, and that's why we've been reducing our debt every year since then. As you can see from our 2026 June results, leverage level has improved considerably. But I want to be quite clear, that is not the leverage level that our goal is to get to as well. We know that there's further to go. And we will get there by continuing to reduce the principal balance of the debt and also by increasing EBITDA. Ultimately, and it's going to take a little while to get there, we'd like to get to around a 3 times leverage level. And we recognize that's not where we are now, but look at the significant change in the leverage level that has happened over just the last 6 months. We went from a double-digit leverage level to now what looks like a leverage level that is less than 6.5 times. So a very significant improvement, and we'll continue to work towards continuing to make those significant improvements.
Okay, thank you. And then on your updated expectations on CapEx, is that an expectation that you would have going forward, or is that kind of timing and just increasing some of the projects ahead of the Q4 slate, or is that also what you alluded to earlier with increased lease incentives from the landlords? There's a little bit more kind of color around that. Thank you.
I wouldn't read anything into future years with that because, as Adam said earlier, we're incredibly disciplined on our CapEx spend, and it will be very box office dependent. We, as we said earlier on this call, have just such incredible opportunities to spend money this year and create significant ROI that will benefit the results that we've taken advantage of the opportunity to do that. We're doing that this year, and we'll have to look at 2027 CapEx, look at the individual projects, look at our expectations for the box office, etc., and at that point decide what our CapEx spend, what appropriate level will be for 27 and going forward.
Okay, thank you so much.
Thank you.
Thank you. At this time, there are no further questions in queue. I will now turn the meeting back to Sean Goodman.
Thank you very much. Adam, I think there's time for just one quick question from our retail investors. So the question relates to equity and capital markets, and the questioner notes that we have done 2 equity raises during the second quarter, and just a question to discuss the rationale for these equity raises and why they're important to AMC, our business.
Thank you, Sean. We've raised a lot of equity over the past 6 years, and that's why when other movie theater chains went into bankruptcy or liquidation, AMC did not. But even we know that the issuance of stock is a precious commodity. We don't issue it lightly. We think very hard about how much equity we should offer and when. There's always a good reason for it. In the case of the equity that we raised in the second quarter this year, we had a debt maturity coming up less than a year from now where we needed to repay $125.5 million of debt. And the alternative to not repaying that debt would have been catastrophic. So we made sure that we raised the cash we needed to prosper. Having said that, we also know, I've said many times publicly, that cash is king. We also know that the thing that separated the companies that survived COVID and the Hollywood strikes is that they had cash in the bank. And the companies that did not have cash in the bank faltered. And in our industry, there were many companies that faltered. And so we've also been quite insistent that we always have, to the extent possible, robust cash reserves so that we have the time to recover. And look what's just happened with the second quarter. Because we gave ourselves the time to recover between the end of 2020 and the beginning of 2026, we put ourselves in the position through a better film slate and a more successful company that was driving revenues and cutting costs, we put ourselves in a position to report a record quarter of $321 million of EBITDA and $190 million of free cash flow. So while the decisions we made were not always popular with our shareholder base, we knew that they were absolutely essential for our survival and gave us the runway we needed to get to the promised land. We're not quite at the promised land yet, because while we were free cash flow positive in Q2, we got a little way to go to be free cash flow positive for a full 12-month year, but we're ever so close. And as I said, we ended the second quarter with $778 million of cash on hand. Tough decisions, but they were made with great care and deliberation. With that, I think the market's opening, so we're going to finish off this call. I want to thank all of you for participating today, both our analyst community and our retail shareholders who joined the webcast. And I leave you with three simple thoughts, which are not going to be a surprise to any of you. Number one, holy moly, what a quarter we just completed. The best in 106 years with $321.4 million of EBITDA. Number two, if you were one of the 4.3 million people in our theaters this weekend who reveled at the Odyssey, it's got a 95% score from critics on Rotten Tomatoes and a 97% score from audiences on Rotten Tomatoes. I would strongly encourage you, buy a movie theater ticket, go out and see the Odyssey on a giant screen. It's how that movie was meant to be seen, and you're in for 2 hours and 50 minutes of extraordinary entertainment. And three, while I think the Odyssey is going to have legs for many, many weeks, just 2 weeks from now, Spider-Man Brand New Day will open in our theaters as well. And our theory, based on the advanced bookings that we've seen, is with all these good movies that have come out this year, especially in the second quarter, 6 movies opening to $75 million or more, Toy Story 5 coming out to $140 million opening, Odyssey coming out to $124 million opening. We think that Spider-Man is going to be the biggest movie of the year so far. So there's going to be a lot of movies for you to choose from this week, this month, and throughout the remainder of calendar year 26. Thank you one and all for joining us today.
Thank you. This brings us to the end of today's meeting. We appreciate your time and participation. You may now disconnect.
All right, gang. Mic check. Yep. Okay. Hopefully you were listening there at the end. What Adam was saying about having equity available. We were having a chat in the comments here about how many shares the company had left. They're getting to the end. 200 million minus any shares reserved for convertible notes and executive compensation. Bigham's checked it. He said, I saw in the comments, around 150 million left. So we are expecting a proxy sometime after July 26th for a September 24th annual shareholder meeting. Keep your eyes open for that. And we will see when we see what is going to be on that. So that's something to think about coming up. Results today, fantastic. We did have one bear, or Maybe one person who doesn't watch my videos show up in the comments today talking about AMC can't even make a profit on a great quarter like this. Guys, you got to look at adjusted net income, adjusted EBITDA. Remember, as I told you a week ago, there was a massive one-time non-cash expense that would impact the GAAP numbers and make them negative. And so if you're only looking at GAAP, or you see anybody on social media saying that negative number means AMC sucks, they are either not reading the filings, don't understand GAAP accounting, or they're purposely pushing some bearish narrative. No one cares about the GAAP numbers. Analysts do not care. Only the bears will care, because it's the one thing they can try and use negative sentiment on. It does not matter. Operational results, adjusted EBITDA, adjusted net income, that is all that matters. That non-cash expense was related to the extinguishment of debt because the share price was higher than the exchange price at the time that the debt was exchanged, and accounting rules say that AMC has to book an expense for that. It's not a big deal. It didn't cost them anything. But it is there. I mean, we can't change accounting. But look at the free cash flow, $190 million. Look at the EBITDA. What was it? $386 million, something like that. This was a huge quarter. And biggest surprise for me, just to recap, if you missed the first couple minutes, the operating expenses were kept in line with previous quarters, even though the box office was so much higher. So maybe I've already gone ahead, and I've been up since 5:30 this morning and already updated my spreadsheet, updated the predictive formula, back tested it and forward tested it so that we can account for that sort of max limit on OPEX of $459 million, even when box office is growing. That is what we call operating leverage. Now we have confirmation what that number is. My spreadsheet will properly account for it. In my back testing, if I would have had that knowledge of exactly what OPEX would have been, my spreadsheet would have only been $6 million off on forecasting net income. So that was the huge good news that you're looking for. OPEX, way lower than I would have expected it. Fantastic quarter. And looking forward to seeing more Odyssey results, more Spider-Man results. We both went to go see Odyssey. I was going to go see it by myself this weekend, and the wife said, I want to see that one. So I took her. She enjoyed it. 3-hour-long movie. It's a long movie, but it is very good. And I hope you guys go see that and, put aside all the noise about the social media nonsense. If you're not going to go see a movie because of someone you don't like on the screen for 5 minutes in a 3-hour movie, then I don't know what to say to you. You don't really support this industry. You don't really care about film. The movie, the way it adhered to the general storyline of the Odyssey was very faithful, very good. Yes, there were some liberties taken. It's Christopher Nolan. Grow up. Spider-Man comes out in 2 weeks. Odyssey's gonna win, the box office for the next 2 weeks. Please go see it. I will be going to see it a second time. We saw it in Dolby. I saw it in IMAX. I will see it in IMAX. And I think I'm going to celebrate today's earnings by going to see Evil Dead Burn or Evil Dead Rise, whatever it's called. What is that movie? Evil Dead Burn. And I will do a recap video for you guys. I want to listen to the earnings call again. I want to read through the 10Q. I want to read the transcript, make sure I don't miss anything important. I will talk with you guys about the improvement in total leverage ratio that Sean Goodman talked about, from double digits now to down under 6.5, 6.5, under 6.5. The term loan, AMC's biggest portion of the debt, is adjustable, variable, depending on SOFR and the leverage ratio. And if you're in my Discord, you guys already know this. We talked about it a couple weeks ago. There is a table in the debt document, in the term loan document, depending on the leverage ratio, over 7.5, 7, under 6.5. The AMC's interest rate can be reduced by 1%. And when you're talking a couple $1 billion, that's a huge improvement on interest expense. So good work to the team at AMC in keeping operating expenses in line. This is huge. Here's why this is huge. When OPEX is kept in line, EBITDA goes up, total leverage ratio goes down, and interest rate goes down. This is phenomenal for forward thinking about what is the now I got to pull out my interest rate calculation spreadsheet and run some numbers for Q3. I'm excited to see how much reduction we're going to get off of the 115 that we had for Q2, 115 million. Rolf says, I'm seeing online that the recommendation for Evil Dead Burn is not to eat while you watch it. All right, Rolf, I'll make sure I go with a settled stomach before I go watch that movie. I saw in London at the BFI IMAX, not AMC's IMAX, but the big 70 millimeter one in London. It sold out to like August 24th. That is crazy. Sold out around the clock till the end of August. Just imagine. Odyssey's gonna, I think Odyssey gets to keep IMAX, right? Spider-Man's not releasing an IMAX. This is just going to be, the next few weeks are going to be fun. They're going to be fun. Watch out for the bears talking to you about AMC lost money. Ask them why don't they understand the difference between GAAP accounting, non-cash expenses, and adjusted net income. Go brush up on their accounting and stop being negative Nellies. AMC, look, if the extinguishment of debt was not a thing, that was $109 million expense, non-cash, that affected the GAAP earnings. Look at adjusted. That is the real number with that fake non-cash expense taken out. Maybe tonight, if we do a live stream, we can model for fun. I need to update my interest expense calculator for forward quarters, but maybe we can model. I see you guys were asking, what happens if the box office is 10.5 billion, 11 billion? We can model that now that I have a new data point on OPEX with this level of box office. We can have some fun dreaming. And remember, at the end of the day, everything happens if you go see some movies and buy some popcorn. All right. AMC trading at 239. Let's go. Have a good day, guys. I'll be in the Discord unless I'm at a movie. And I'm going to be spending the day prepping exactly what I want to say in the brief recap. I'll probably do that after market closes so we can see how the stock trades throughout the day.
Up and to the right. Up and to the right. Up and to the right. Hello, millionaires. Short squeeze plays where fortunes flip. GameStop's journey, an epic trip. From humble roofs to the moon we fly. A company's dream will amplify. Ready warriors, keyboards in hand. With their eyes on the prize, they took a stand. No one's selling, we're here to fight. How does it go? Up and to the right. Up and to the right, we're in for the ride. It's us on the rise, it can't be denied. Up and to the right, through the day and night. Together we'll soar, the last is in sight.
Surprise.
We're gonna win.